Evening to all of you. Welcome you to today's webinar. Today we are going to look at some of the important structures in options. We have had webinars on the basics of options already before. Many webinars we have had. So we may be able to recap what's a call option, what is a put option. And so we are now not looking at the terminologies and not looking at whether the strike rates, in the money, at the money and all. What we are going to look at is where is the present market and what structures that we can do. So anybody who has any questions on the basics can definitely ask those questions also later on. Now, let us look at the present situation of Nifty just for illustration, so that you can build the same thing for Bank Nifty also. First of all, when you get into option, you must list out the reasons for why you want to do the option. Okay. Now, and also you must understand the characteristics of the option. So first of all, must try to find out the reason for doing the option. Okay. And also you must understand the characteristics of any option. Because these are two important things. Without this knowledge, if you enter into it, you may get into probably results which will not be acceptable to you, and you will find it difficult to digest that result also. And you'll try to find out the reason as to why your gains are limited or why your loss is more sometimes. The reason I'm saying this is that the reason why you should do an option could be probably for rationalization of resources. That is, instead of futures, you would like to do options. Okay. Instead of futures, you would like to do options more from the point of money management. Because here you have to pay more margin. Here you have to pay more margin. Here you pay only the premium. Let's say you are buying options, so you pay only the premium here. So considerably less outlay as far as options is concerned compared to futures. So from money management point of view, you would like to do the options compared to the futures. Second is, whatever happens, whatever you think of doing with the options, when you're buying an option, even if the world is going to have, it's not like a pandemic situation. Something happens, a black swan event happens. Then also you know that the maximum loss is going to be the premium that you have paid. So this is the reason why you will go to sleep very happily. Okay, you know that you are not going to have a problem which is more than the premium that you have paid, right? So based on this, you would like to do the option. But at the same time, there are downsides which can happen most of the time, because the black swan event, or what we are saying is the tail end risk, or once in a year situation, or once in a decade situation, it doesn't happen on a every week basis, right? So but when you have a profit and loss for a couple of 10 weeks or 15 weeks going down the drain, then probably you lose interest in doing options. So you must also understand what are the characteristics of an option which is bought. So the characteristics of option could be the time. First important most is the time decay, right? So the volatility, all those other parameters come into play. So the most important thing is the time decay, which you have explained earlier. We've seen this market in the last 2-3 weeks. This is just going in a range bound between 17,450 and 17,750, right? So this is what happens. Last 2 weeks, I think it's closing somewhere like 17,540, 550 levels. So approximately around this is the close. Now of course we don't expect this to get stuck only in this place. So there will always be movement around this. And also sometime it has to move away from that particular level. So we do not know whether this will happen this week, next week, or when it will happen. But right now it's going like this. So the last couple of weeks, suppose if you say that you bought an option, call option, 17,500 or 550, the entire premium would have got wasted because there is no proper movement. There's no proper movement, and so the entire you would have probably ended up paying the option premium. Whether you rolled over the option or the option which you did in the upfront, you just kept it there. So what happens that no, probably you would have ended up with some losses there. So what is the best way to go forward? You must understand from the chart, and also what type of structure that you should do which will fit in with your risk appetite. Okay, so the option structures will depend on the present trend in the market. So that also you should know, present trend. Okay, then premium or the margin that is required for doing any option, the resources that is required. And third thing is having done a particular option structure which will matches your risk appetite. Okay, what will you do with this option, whether you will be passive or dynamic in the sense that depending on the market movement of certain percentage or levels, you would either roll over the option or you would just be passive. Okay, so these things you have to jot down in your trading book before you enter into any option. So we will look at one or two structures based on this, that is what is the present trend, what is the premium or the margin money, and what is the premium suggest, because we have also highlighted that the premium itself can be used to know to what extent the market will generally close. Okay, and what could be the high to low for in that particular week or in that particular month. Generally option gives some reference points for you, not necessarily it will be you have to stick to that, but you can say that the very high chance that let us say if I say 175 rupees is the money option for next week, then I could expect a 500 point movement high to low. Generally speaking, a 500 point high to low movement can take place in that particular week. So this is the general thumb rule that we keep. Similarly, if 175 rupees is the premium that we have paid, the close to close basis, suppose this week close to next week close, most of the time can be, that is most of the time means what I'm saying is, in the case of a downside, 85% of the time, that is if you take 10 weeks, okay, on a longer period of time, I'm saying don't take it only for 3-4 weeks, a longer period of time, 8 out of 10 weeks, it will close within that 2 times of the option premium. That is, if 175 means 350 rupees. The 350 means, suppose if the market is closed 17,650, generally we can say that it will close be above 17,300 next week. 17,300 next week. Similarly, the upside, if it is 17,650, you can say the close will be, generally speaking, will be below 18,000. Okay, so this will, along with your technical indicators, the open interest in any particular strike or the option premium will give you some guidance as to where this particular expiry that is coming for which you are doing the option will have. Based on that, you can look at some structures also. So present trend, the premium, and then the margin. We must also know to what extent we can pay for any margin there. Then what is the risk appetite? Because when you say buying option, then of course the risk appetite is known about the premium that you are paying. But in case if you do some structures like let us say you're doing a butterfly structure, or you're doing a 3-leg structure where there is an open sell either in the call or put option position. So those things we have to understand the risk element involved and put in a risk appetite structure according to that. Then passive or dynamic, suppose if you do a structure and say whatever result that comes, I will accept it. That is the passive thing. Dynamic is that you try to roll over the option in that particular time frame that you have done for the option. Let us say if you are done for next week, which is 15th, then in that case within 15, depending on the movement in the Nifty, if it goes up or down, you adjust the position. So that is dynamic. So traders normally do, active traders normally do some dynamic positioning of the options. Okay, so these things are to be understood for an option player to come. And also of course there are other things like whether you should do in the money, at the money, and out of the money. All those things we have already discussed before. But right now you are looking at the these things to highlight one or two structures and see how it fits in. Now, first of all, you can look from the chart or you can look from the option premium also, because the chart will tell you what the present position is, okay, but you may have a judgmental view, okay, that in no Nifty, I don't think so it's going to go up, it's going to go down, but to what extent it's going to go down within that expiry period. So for that you may look at the chart. So let us say you are taking a bearish opinion. I'm not giving a bearish opinion, but let us say you have a bearish opinion on Nifty. Now you will also look at to what extent it can go down within next week if you're doing an option for 15 September, and also what are the support points in the chart. So these are two important things that we must know. So first let's look at the chart for a bearish view of the market. See, we have seen, let's put a weekly chart, because we are looking at a weekly option. So weekly chart, and in this, let us look at the this one. See, you can see the high to low 17,726 to 345, approximately 400 points. 400 points. This week, of course, it is 17,166 to 17,777. It's 600 points high to low. So it has it's been quite volatile, or quite volatile. And this week till now, that is this week as today being Friday, Wednesday. So you've got 2 more days left. We have got a 484 to 764, so less than 300 points, right? So less than 300 points. So the volatility can expand by another 150 points. So probably we could see 150 points on the downside. Possibly, it could come 17,325 to 340 levels, or there is a chance that it can go above 764 and go up to 900. So these are possibilities that we can have, depending on that, based on the option premium levels. Now, option premium levels. So along with the chart, we will read the option premium also before we put in the structure. Now, this is an important support, right? So 17,155, 166 is an important support, and for the market to sustain, this should not break 17,166, let us say. So let me say 17,200, round about 17,200 should not be broken. Okay, so let us look at structures based on that one. And second thing, we have also seen that 17,166 to 17,777, if you put a Fibonacci, even the 23.5% retracement of this from measured from the bottom comes closer to 17,270 or 280. So roughly we will say that on the bottom side, generally speaking, we should not expect a fall which is much below 17,300, 320 levels, okay, for this week. Okay, and worst could be around that 17,250, 17,300. But if it starts breaking 17,150, then we are totally on the we should be very much concerned about the overall trend of the market. Okay, so this is the view right now we have. So within this, how do we make a bearish structure? At the same time, if it is to go up, then we are still not bitten. So this is the very small loss. So this is the based on the risk appetite that we have. Okay, so I would like to based on this, we will look at the structure. Now we are at, say, 17,600 approximately, I'm saying. Okay, 17,600. So my opinion is 17,600, and we are saying that it should not go much below 17,200, right? So if it starts going below that, then there is no point in holding the structure. So 1:2:1. Let us say we do 17.6, 17.4 and 17.2. So that is a butterfly option. So let us say 17.6, 17.4, 17.2. Let us see first of all what is the premium that we have for this for the coming week of 15 September. So 17.6. So we go to the option chain here and look at the 17.6. See here, if you look at it, at the money is 17,650 approximately. Okay. Now the premium average of the call and put is coming closer to 180, 180, 182 or 183 rupees, which means into 2 I told you. Normally market does not exceed that. So 370 points. So let me say 400 points. 400 points from the present level is 17,224. So that's why I'm saying it should not go much below 17,200. That's our view in the market overall. And it can it can be between 17.6 and 17.2, or it can be above 17.6 also. Okay. My entire intention is if it falls, okay, whatever profit I get between 17.6 to 17.2 is okay. Okay, I will even be passive. Whatever I get, I get. And if it's above 17.6, let me see what is the maximum loss that I will have. Suppose if I put a butterfly structure between 17.6, 17.4 and 17.2, let me see what the premium is going to be. 17.6 is 164. The 17.6 put is 164. 17.4 put and 17.2 put is what we are going to see. $17.4 is 94. So this we are going to do 2 times. That means 188. So up to this we are getting 24 rupees credit. 24 rupees credit. And our break-in is going to be below 17.2. Okay. Now, one is that you can do a butterfly. Second, you can do a ratio spread. Ratio spread is, I'm willing to take the risk because I feel the market is not going to below. See, that's a view. Okay. But I'm not suggesting this because doing any black swan event, this 17.2, if it's going to be hit, then we are going to be in a very painful story. So we have to be very careful about it, because at that time we may not be able to manage that also. So definitely a risk management strategy is required. But I'm saying those 1:2 structure, if you do, then in that case, no, you just do, you get the credit of 24 rupees. And anywhere between 17.6 to 17.2, you're going to make money, okay, in this. Okay, because you're not doing the structure. Till now we have not done this. This is only a ratio structure we have done, 1:2. Because you have got a view that probably if it's false also, it will not be below 17.2. Okay, 1:2 you are doing. Okay. And if it goes up, you are getting a credit of 24 rupees. You're going to get a credit of 24 rupees. So there is no loss for you, right? So anywhere, right, from 17.2 upwards to anywhere, you're not going to be at a loss. You're going to still get a credit of 24 rupees. Now, I'm a very conservative person, right? So I do not know what will happen. So because once in a time, this 17.2 can be taken off. That time I will not be able to manage. So let me see what is the premium for 17.2 to close this trade. 17.2 is 50 rupees. 50 or okay, approximately 50. So net I have to pay is 26 rupees. So anywhere between 17.6 and 17.2, okay, I am going to make money. Let's buy 26 rupees. Let's buy 26 rupees. On expiry date, if it is going to be exactly at 17.4, I'm going to make the maximum money. Okay. But anywhere between 17.4 to 17.6 also, I will make money, because there will be, even if it's closer to 17.6 on that day, there will be some value for that, and I will still make money on that day also, right? So generally speaking, this seems to be acceptable, because you are going to maximum lose 26 rupees. 26 rupees, okay. Now assuming that you don't want to pay this 50 because you feel that it's not, 17.2 is not going to be broken, but at the same time you would like to have some guard, okay. So that means you may not do 17.2, you may do something like a 17.1 or something like that, okay, so that you're giving yourself some elbow to ensure that you don't pay a premium or pay less premium. But in the event of something going very bad, okay, you are prepared to pay that 100 rupees extra in case if something goes bad. So let me see that. What is that? 17.1 and 17. 17.1 is 37 and 17 is 26. So this is 37. If you, instead of 17.2, you do 17.1, you will pay 37 rupees. So you have received 24 rupees. So you would have paid 13 rupees. So the worst case loss will be that 100 rupees plus this 13 rupees. So 100 rupees is the maximum loss that you will have. Okay. But in case if the market goes up, okay, then in that case here you would have given 26 rupees. Here you would have given nothing. Here you would have given nothing. Okay. Now if you do 17,000, then you received some 26 rupees, so you would not have paid anything, but you would have safeguarded against extreme movement. You would have got safeguarded against an extreme movement, but if the extreme movement happens, then you don't mind paying 200 rupees. That's what it says. Now, question is you are making some compromises on what should be done. Okay, you're trying to make some compromises on what is to be done. Okay, so in the case of an extreme situation, now you will end up having some issues which is to the extent of around 200 rupees. Now it is for us to decide what we should do, whether we should have 17.2, 17.1 or 17. That will purely depend on the trader's call in the market, okay, and how much risk to reward that he is looking at. So if you are a very conservative person, you can try this for 26 rupees. You can try this for 26 rupees. But in case if you feel you need to take this off, suppose let us say 26 rupees that you are paying, you would like to get that back. You get that back. Then we should do. Suppose let us say I'll tell you what should be done. So 26 rupees you are paying. So that's 17.6 to this one. So let us say the market goes up, so you would like to take back this 26 rupees. Okay. So let us say you do a opposite call spread, 17.7 to 17.8. Okay. So let us see what is the premium for this. 155 and 111, 145. So this comes to 44 rupees. Let us say this comes to 44 rupees. So what you could do is, since you want only 26 rupees to be taken, okay, if the market goes above 17.8, you will get 100 rupees. You don't want 100 rupees. No, you just want something of this. So probably you can do, suppose if you do 3 trades of this, then you can do 1 trade of this. Okay. You can do 1 trade of this. Suppose if you do that, then in that case you would have paid 78 rupees here, you would have paid 44 rupees here. Okay. 122. So probably your loss is going to come less. So instead of 26 rupees, see you're going to do it's like this. To understand this, so you are paid 26 rupees. Now you are going to get 100 rupees here. Right? You're going to get 100 rupees here. Now you want to get only take 26 this one. So that means in this 100 you have to do 0.26, right? So if you have done 1 trade here, 0.26. So if you do 5 trades here, approximately 1 trade here, right? So what happens is that when you do 0.26, okay, then 100 into 0.26, you will get 26 rupees. You will get the same 26 rupees. You will get this back. But 44 rupees you have already paid for this. So 44 into 0.26, net loss will be something like a 10 rupees in case if it goes up. So you're trying to reduce this 26 rupees loss to a lower loss in case if it happens. But I think probably instead of taking all those risks, better, because this amount is only small, you can just leave it there, of 26 rupees, and you can put in a stop loss if it starts to go above 17.8, because now you know that it is the bullish trend will be up once it starts edging above 17.8. So once it starts going above 17.8, I think probably this 26 rupees will start diminishing in value. Maybe it will come down to 15, 16 or whatever it is. You can remove that structure if you want. You can remove the structure if you want. Okay. So this way, you can look at doing this particular structure with a very minimal risk and with a high chance of making good money. Okay, with high chance of making good money. Okay, so a butterfly option, or what we call as a modified butterfly option. Okay, where you take a slight risk on the downside, where you are combining one sell spread. Okay, along with a butterfly, along with a ratio. So when you do this, you get a modified butterfly spread, which also can be tried in case you have the appetite of taking some risk of say 100 rupees or 150 rupees in the event it goes down, which is as per the option premium, it indicates it should not go down. It should not go down. Okay, so this is the butterfly spread on the downside. Now, normally when you do, suppose let us say you have a view which is on the upside of the one. Okay, so normally what you have got here in the case of a put spread, the same sort of a value you generally don't get in a bull spread, particularly bull butterfly spread, because the volatility skew in Nifty is like that. Okay, so higher the strikes that you go, you receive less volatility, you receive less premium for the volatility because of the lower volatility of higher strike rates. Because of that, you may not have the same value of what we did is for 1:2 where we placed it 200 rupees away. Similarly, the same thing if you look at what we can do is 17,650 right now. Okay, so we'll look at 17,6, 17,8 and 18,000. 17,600. And another thing, what I want to tell you is that the modified butterfly spread that we showed you, where we are losing only 13 rupees when you do a 17,6, 17,4 and 17,1. So we don't need to leave it like this, that 113 rupees. We said the stop loss should be, if it starts to go below 17,200, it's not worthwhile, 17,150 or 100. At that time, we can even remove this. Probably at that time we may not pay 100 rupees. Probably at that time, so say for 50, maybe it will, the structure we can remove it at 50 rupees or so. So the loss can still not be 113 rupees if you put a stop loss, or probably move the 1700 to 17,200. Okay, back at that point of time, we may not end up with a big loss. See, what can happen is that we must know how to do that. See, because normally what we see is that the market can go a little bit lower and then bounce back. That's also a possibility. So what we should do in this case is that if it starts going below 150, then 17,000, what we have done is 17,6, 17,4 and 1,700, right? So the 1,700 can be moved back to 17,200. The reason I'm saying is, instead of putting a stop loss, is you may pay a little bit of a premium here, okay, but that there's a chance that it can just bounce back and then come back to 17,5 or 17,4. Right? Sudden spike can come. No, so instead of us, let us pay the premium and wait and see what happens at that point of time. So what we should do is that we should keep ourselves ready. That we have paid only a premium of 13 rupees till now. Okay, 13 rupees till now. Then maximum loss is only 13 rupees if it goes on the upside. Okay. For that, if you want, you can remove it above 17.8. Okay. Now 17.6, 17.4, 17.1, when you do the structure for 13 rupees, if it starts to move below 17,150 or so, that time what we can do is 17,100 we cut and then move to 17,200 and pay the extra premium, which could be 50 rupees, because 1700 and 17,200 will have the same probable time value. So the intrinsic value you will pay is 50 rupees. Now at that time, say 50 plus 13, 63 rupees we have paid. There is a chance that even if it comes back and closer to 17,250 to 17,260, we may not have a loss. may not have a loss, right? So that way, we can look at the structure like this, okay? Because generally speaking, now 17,150 should not be cut, because that is a very important weekly pivot. If it starts to cut, we will remove the 17,100, 17,200 and do a 50 rupees difference only. We can take it and leave it there also, right? So that way we can look at some way of managing it, at the maximum, pay that 50 rupees at that point of time and leave the trade. Instead of paying 26 rupees now, let's pay 13 rupees, and in case if it starts to fall, we pay that extra 50 rupees and come out of the situation, okay? So that is one way of looking at it. So now we will look at the bull side of the market. So we look at 17.6, 17.8 and 1800, because right now 17,600, so we expect it to be around this 18,000 maximum, let us say. So 17.6, 17.8 and 18, we look at this 1:1. So 202, 17.6 is 202, 17.8 is 111, right? So 202 and 111. So if you feel again 18,000 is not going to be hit, I think we can leave it there, right? 17.6 is 202, 17.8 is 110, so 111, 222, so we are getting 20 rupees there. It is 18,000, which is 50, 18,000 is 53. So we may end up 20 rupees we are getting here, so 33 rupees. So 33 rupees is what we have to pay here. So this is one structure also, that's also good. So if you are a bullish but with a limited this one, you can look at this. Suppose if you feel that you got a very limited bull view, okay, it is not going to exceed 18,000 because the situations like this. What you can do is 17.6, 17.8 and then 18. You can do this structure immediately, or if it starts to break 17.8, now let us say you are doing 1:2 only, because margin then will come, okay? So for which you need to put somewhere some distant one, at least you need to put it. I'm talking without referring to any margin. Now suppose if this if the Nifty has not crossed 17,780 till now, so the last couple of days, so if it starts to cross 17.8, then at that time you buy this 18,000 call option, okay? Probably you may end up buying more, okay, at a slightly greater rate, but it is better because if it's not crossing 17.8, in that case you get a good profit. Right? So and if it falls also, you're not at a loss. So you can look at that point, or you can look at the modified structure which I told you. Instead of 18, by paying 53 rupees, you can do something like 18,100, which is 34 rupees. 18,100 is 34 rupees. So same thing, 18,100 is 34 rupees. So here you pay only 12 rupees. 12 rupees, and you're taking the same risk of 100 rupees. But in case if it crosses let us say 17,000, 18,000 itself, then in that case you can, as I told you, can bring that 18.1 to 18. 18.1 to 18 level you can bring. Now you can combine these two structures also. And look at the 17.6, 17.4, 17.1 for 13 rupees. Put spread, put bear, put. Then butterfly call 17.6, 17.8 18.1. Same, I think. Yeah, around 13 to 15 rupees. So what could happen in this case is that no, if nothing goes wrong, then anywhere between 17.2 to 18,000. Okay, you're going to make money with a 25 rupees premium or 27, 28 rupees premium. So in this range, minus the 28 rupees, you're going to make money, which is an extremely good thing because you've got a protection there, because not because you've got a protection at 18.1, you've got a protection at 17.1. Okay, so it is up to you to decide where exactly you would like to act. Here, if it cuts 17,150, you act and move the 17.1 to 17.2. At that point of time, I don't think this will have any value, but whatever value, if it is there, you just cut it off. Okay, and move the 17.1 to 17.2 and pay 50 rupees at that point of time, and just see. So maximum loss, if it goes there, will be 60-62 rupees. Similarly, it could be 60-62 rupees here. Okay, so the profit on either side could be something like a 200 rupees. Go up to the maximum. So it may not go up to that. But what I'm saying is that in case we are not forced to act on any of this particular level, then in that case we have got a good profit. Profit will come mostly because the 25-26 rupees from 17.6 it will move, right? So somewhere around that. Even if it doesn't move on that day, also you will have that 25-26 rupees there. So the decay also will help you on that day. I think it is a good structure with a decent amount of margin, and the return on investment could be quite good. So I would prefer to consider, because here is the time when we are not in a position to look at whether it is going to go up or go down, and the general feeling is that we should now be looking towards in Indian market is now delinking itself from the global markets. By this time we should have seen the Indian market also going down, because S&P has gone down below 3900. So the correlation has got broken for the time being. We do not normally the correlation gets established over a period of time. So that means the bullish tendency should give way, and at some time we should see a crack of 17,450 to happen. Okay, and if 17,450 happens, then 17,340, 330 is there, then 17,150. So we should not take any big risk. We are taking a risk. Even if you are not able to do anything, it's 100 rupees. Okay, even if you are not able to do anything, it's just 100 rupees. Okay, so with that we should be looking at this particular structure. But if you feel that at any point of time it can fall 17.6 to 17.2, you do just do it for 26 rupees. And if you do a bull spread, it will come to 32, 33 rupees. But I think that will probably can be still profitable. But I think if you can look towards taking some small risk on one of the sides, it is better. Okay, so if you don't want to take a risk on the sell side, then you can go for 17.2, 17.4, this one, and then on the top side you can go for 17.6, 17.8, 18.1. You can always put in some stop loss for any one of this at some place or the other. Okay, so this is the type of this is one structure which we wanted to bring to your notice, and probably you can practice this, because I think the first step that you should look at is always try to avoid loss. So that is the most important thing that you should always try in markets. That is, first of all, try to avoid loss. And once you avoid loss, or minimize your loss. I wouldn't say avoid loss, because then you can't be in the market, but keep your losses minimal, in a manner also that even if you're not able to act in a market, whether it's on the bull or bear side, because equally there could be some big announcements on the positive side which can take the market up in a single day in a very significant manner. Because what happens if Russia-Ukraine goes for a ceasefire? It could be a very big positive news. What happens if the situation like what's happening right now, the gas supply being cut to Europe, the situation deteriorates? So we have no control over that. The black swan event can happen. When we say black swan event, it's more on the downside is spoken, but upside also it can happen. So we need to be careful about it, and we should understand the characteristics. So what we have done in this case, in this option structure, is we are looking at some sort of range bound within at with the time decay coming to our side. At the same time, we are looking at paying very less premium and taking no risk or very less risks. So that is what we are doing in this situation, right? So now there are these options. There can be many ways of doing this option, and one is to roll over the options also. Like you do whether you do a spread or whether you do a plain call or put option to replicate the futures. You could just keep replicating the option, replicating the futures with the option. Okay. The reason you are doing that is basically to ensure that the resources allotted for the futures, that much is not required for an option to do that. Okay. And also the maximum is that you are going to lose only this much. So these things will be helpful for you. So we must study how whether a spread option or a plain call or put option, if you keep rolling it over, what are the consequences of that particular rollover? Okay, and how we should do that, because the reason why we are suggesting all this thing is that some of you may be fed up with stop losses, because see, trading is a very highly psychologically draining aspect. So you keep getting too much in and out, you'll have your own problems. So you should, if you can get something to do without getting into too much of a stop losses, but at the same time, if the worst happens, then you are prepared to take that. Okay, then in that case, you can definitely adopt any of this. Now, another advantage of this, what we have talked about, is in the case of a bear structure that we have talked about in the bull spread. Sorry, in the bearish butterfly spread. If the market is going to sink, then you can buy tomorrow a Nifty at a lower value, and then when it rises, you are going to get money back. So whatever loss that you are going to get it back, right? So to that extent, that is an advantage. Like selling a put probably at least enables you to get a premium. That I'm not suggesting you should sell a put, but what I'm saying is, if the market sinks, then whatever strike at which you have sold becomes the strike at which you have bought the market. Okay, plus you got some premium there. So it is something like this. So one has to convince some that why you should do this, and what will be your approach in case if it goes down also. So that sort of mental built-in that you do will enable you to see the option in a different light. Another thing is that the option premium being paid always, we should not keep on paying too much of a premium, because it will become a waste of money, right? So it can become a waste of money. So we have to control all these things while doing some of this option structures. Okay, so now the rollover of options is what we want to discuss, but time is not there today to discuss. So next week, we will look at how to what type of an option, the rollover of option. That is, you do a spread option, okay, and how do you roll it over, or a call option or a put option, how do you roll it over, and how you should see that when you're doing a rollover option, just think about. Last week it fell from 17,000, say 750 or so, to 17,450, and again it's back to 17,650 or so. Okay, in this case, from 750 to 450 when it comes, it is better that a rollover of option would have been more helpful than just sitting plainly with an option at 17,750. And that rollover of option would have been more useful uh, than even a futures, because the futures you would have lost up to 300 points here, 300 points here. And in the case of an option, when you do the rollover, okay, when you do the rollover, the single option, the loss, because you would have done other money option, you would have lost for 300 rupees, you would have lost 150 rupees, but you will be paying the premium at the present juncture, not of what you paid at 17,750. So from 450 to this one, so this will be much closer to the break even, much will take you very closer to the break even point. So when you have a fall which is more than the no, double the option price, then you get an advantage which is better than the future. So in a market where you can expect a down fall, in that case rolling over of the option is a very important concept that you should consider, in case if you are not willing to put a stop loss for a call option, because if you put a stop loss, then again you do not know where to buy, whether the futures to buy or the call option. So this problem, if you want to avoid, we should look at how to efficiently roll over strategy in order to get what we want. Okay, so we will discuss this particular point, and also the replication of futures or cash market position through a spread option. So this we will discuss it in coming week, along with the rollover of these options. Thank you very much. So please ask your questions now. Thank you. So thanks for your participation. See you next week again. Thank you very much.